From the morning reading, the QQQ rises as SPY pauses on Monday. Google gaps up in after-hours trading. 6 of 9 sectors moved higher on Monday. XLU, XLY, and XLB were the strongest sectors, while XLE was the weakest sector. Oil fell 2.08 cents to close at 31.62. Breadth weakened as decliners led advancers 1.04 to 1 on the New York Stock Exchange and 1.03 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:26 a.m. Central Time, and I'm recording this in preparation for the market day of February the 2nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report, and we had a fair amount of overnight action, generally weak, and indeed if you look at the 4 U.S. broad market indices, at the time of this cut, we were down over 13 points and closing in on about a 0.75% drop. Now, it should be noted that yesterday we were also down about this much and ended up closing that gap during the course of the day. So while this seems like a good bit of weakness, given the current volatility, a lot can change in even just a few hours. Russell futures also down about 0.75%, as is the NASDAQ, and the Dow futures are down about 0.2%. Crude oil down very big, down 3.45% in overnight action. Euro up about 0.25%. Long bonds up over 0.5%, and gold down about 0.2%. In overseas action, quite a bit of volatility there as well. China up over 2.25%. Hong Kong down about 0.75%. Japan down almost 0.2%. Germany, our primary tell as to where our markets might be going, is down over 1%. United Kingdom down about 1.5%. In terms of macroeconomic reports for today, you know what? I didn't update that. So we won't have that today, sorry. And then we'll go to market condition. Current volatility, short-term VIX down below 20. Skew has jumped a little bit up into the caution area, now up over 125, so we need to keep an eye on where that might be leading us. IV percentiles are all very, very low, and especially compared to where they have been in recent trading. S&P IV percentiles now at 27, Russell at 37, NASDAQ at 34, and the Dow at 34. So all pretty much in that lower third range. There were no standard deviation moves put in yesterday on the 4 U.S. broad market indices. So a bit of a consolidation day, as you'll see in the charts after the big moves on Friday, where we had 2 of the markets with 1 standard deviation moves and 2 of the markets with 2 standard deviation moves. Let's go ahead and go to the charts. And first of all, we'll start off with the SPX. And you notice yesterday, we'll zoom in a little bit here, how after this big, huge, very bullish candle where we had the breakout on Friday from this consolidation zone, we had very much a consolidation pattern here, pretty much a doji, perhaps a spinning top, big time just consolidation. I would note that the fact that this was even green and held up as well as it did, obviously it came down to about halfway through this candle. That is a classic bullish retracement pattern after a large candle, and that we retraced about half this candle and then it ended up closing up for the day is pretty remarkable, and certainly says a lot about the short-term power of the bulls. If we look at the futures, it's a little bit of a different picture in that it ended up being more of a doji and a little bit down for the day, but still It's a consolidation pattern. The fact that it retraced a fair amount of this large body and then ended up here at the close, not too shabby. Though you'll notice that with today's overnight action coming into today's market open, we've had significantly more weakness, and we're really kind of testing back down towards the middle of this candle again. So it'll be kind of interesting to see where this goes. It wouldn't be unusual to see something of a flag pattern here before continuation if the bulls are going to continue to take this. And as it stands right now, we're expecting that the first probability, highest probability, is that this will, for the short term, continue to move in a bullish direction, perhaps break out of a bear flag pattern here, and then move up towards this area right here at about 1986 to 2000. So right into this zone right here will probably mark the first significant area of resistance. If it gets past that, then we'll start looking, and we'll look at the SPX again to fill that gap right there, coming up to about 2045. That would be a big move from where we are right now, some additional 100 points, but would take us back towards the upper part of this big wide range that we are now in since last August. So right now we are a market in transition in a very large wide range, and we're just moving between the upper parts of this range and the lower parts of this range until proven otherwise. When we take a look at the Dow, very similar pattern to the S&P yesterday, and the NASDAQ actually held up better than the others. Certainly a much larger green candle, didn't come down. It doesn't seem quite as far. Perhaps it did. And then the RUT also had a very similar kind of pattern as the other. So all four indices, nothing remarkable to distinguish really one from the other in yesterday's action. In terms of volatility, obviously this has been ebbing down, though it seems to be kind of stuck here at about 2150 and not getting much lower here in the short term. If we truly are going to go more than a short-term pattern bullish, this is going to need to come down, and we'll need to see this drop actually below an 18. And you notice as we zoom in on this pattern, this has barely gotten below 18 in a number of months now, and that is not the land of the healthy bulls. The healthy bulls are down there in the 12 to 18 zone, and we continue to be working at these elevated areas. So what do you expect from that? You expect that when you have bearish moves, that they move harder and faster and farther, and whereas bullish moves probably stall and don't go as far. So we have kind of a conflict here between volatility telling us to expect things to be still very much in a bearish stance, whereas the short-term patterns have been, certainly improving significantly and have been pointing to more of a bullish pattern. So where will all this fall out? Well, certainly we'll continue to watch these signs. The other thing that tells us that the bulls are not in control in the equity market is this continued strength on the long bond. And we've been playing, really now we have what we would call about a, well, it's a significant range of resistance here, where we've had about 4-5 touches. And if we get a breakthrough and close above this 161.19 area on the long bond futures and on the TLT, where you might be trading, we're looking at this area roughly around 128. If we see that we get a breakout above 129 and this swing high here, we'll likely see that the bonds are going to move all the way up to the 132 area. If the bonds are doing that, that's probably not good news for the stock market. The stock market is probably moving down pretty significant. So you have bonds and volatility telling us that things are very, very defensive, while at the same time you have the stock market saying that it is wanting to be short-term bullish. Well, where is it actually short-term bullish? Well, it's short-term bullish mostly in the very most defensive of sectors. And we take a look here at XLU, which is the utilities, and utilities is not normally a leader, but you see utilities has had a significant breakout. And as the broad market has come off of this consolidation pattern and in recent days been moving up, well, look at what bonds, look at what utilities have done. Utilities have just exploded out of that range and then ran right past this swing resistance area. It stopped there one day and then promptly plowed through that on the very next day. And now here we are. Of course, markets are not random, and we intraday reversed yesterday against this prior swing area. So it'll be very interesting to see where these continue to go. In our overnight, we know that the long bond is fairly strong. That would seem to tell us that these other interest rate sensitive markets are probably also going to be opening up strong today. I would not be a bit surprised if this swing high is taken out very early in the day if the current futures markets continue to hold up into the close, which is a little less than 2 hours away at this time. So anytime that you're seeing these kinds of sectors as our leaders, that is not good for the broad market equities and really calls into question. So let's take a look at our daily report. We have had some changes here, and indeed, as we anticipated and discussed yesterday, we did meet that last criteria to move in our market trend intermediate term phase opinion to phase 2. This is considered the trend reversal, a foot in the water, and the primary characteristic is selling puts and normal size stock positions. That being said, we continue to see a lot of reasons to be defensive, and it's not just about XLU and bonds and volatility. While there are signs of good marks for the bulls, indeed the IBD portfolio investor posture is in confirmed uptrend, the accumulation distribution chart for the S&P is still an awful E. NASDAQ also still an awful E. GMI index still a full out 0 out of 6 with a sell signal that's been in place ever since 1210. That author remains very happily 100% in cash. When you look at the decision point scoreboards from stock charts, all 3 time frames, all these different markets, not a green arrow to be found even in the short term of yet. That's how much technical damage was done with that recent correction, and it's going to take a bit of distance before these things start to flip, though we certainly have made up some ground. Question is, at this point, is this just a bear market bounce, at which point it will roll back over, or is it something with more legs? Intermediate term market posture is bullish, but we still have that very bearish sentiment line. That is the most long-term in posture and is the least sensitive, so it takes a while to turn that line. But what that tells us is that the expectation is that bearish legs will be longer, more pronounced, whereas bullish legs are likely to be shorter. So that is not a good news for the bulls at this point. In terms of position sizing opinions, both sides, in terms of portfolio, that is now at 100%. In terms of volatility base, in that 18 to 24 range of the VIX, that is calling out at a 50 to 75% position size. So you could see somewhere between 50 to 100%, depending on what your style of trading is and how aggressive you are, would be the call for current position sizing. In terms of that intermediate term market posture, you see we're still bullish with that very bearish sentiment line, and indeed all 4 of these have been slowly but surely improving in their scores. They're well up off that 20 area now, and indeed 3 of the 4 have crossed the 30 threshold, and even the Russell is just barely below 30. So got a little ways to go to get to 50 yet and become a much stronger bullish intermediate term market posture, but this is a significant improvement over where we were a week or two ago. In terms of hedge warning status, our current risk level opinion is threshold level 1. This is the yellow light. It is reflective that the probabilities for a significant down move are somewhat elevated, with 0 being normal full out bull market and 3 being highest risk market in correction. Right now at level 1, this is elevated but not significantly elevated, so kind of keep that in mind. Stock short-term risk profile 6, medium-term risk profile a 4 on a scale of 1 to 10. In terms of the specific metrics, you can see that still improving here. Quite a few of these are in kind of their normal settings. Really only in terms of warnings are the VIX futures being up over 18, and the skew just yesterday put us back into this cautionary area. We really get much more concerned about this when this gets up over 135. Right now at 125, there's about a 9% probability of a 2 standard deviation move within the next 30 days. In terms of new highs, new lows yesterday, we almost hit the 300 mark, and where we would make it significant versus only 57 new lows. In terms of the intermarket risk aversion indicators, we still have 2 of the 5 flagging as risk off. These have been slowly but surely improving. In terms of the fear and greed index, we're at a 27. This continues to improve, and you see a week ago 15 and yesterday 26. So that also continues to improve. In terms of special opinions, in option income strategies, the VIX is still outside the acceptable window to initiate new positions for novice traders. We need that volatility, as we talked about. It's still quite elevated, and with that would be the expectation that delta and vega moves could be much larger and more frequent, and as such probably not the ideal condition for option income strategies for novice traders. Now, more advanced traders, more aggressive traders would certainly welcome the higher premiums that can be found, but you of course are position sizing in a way that you have the capital to make those adjustments that will come with those higher volatility areas. Cover call strategies and put sellings, conditions are acceptable for both of these now for the initiation of new positions with novice traders, though you might want to take advantage of a number of the defensive postures here that we've outlined, given the amount of hedge risk level still level 1, and a number of those other warnings that we talked about at the beginning of this report. Some of those things might include using in-the-money strikes. Some of it might include using lower beta positions. You might also want to leg in to cover calls using conservative setups through well out of the money put selling. Might want to consider using a reduced position size. And certainly if you're selling puts, keeping those position size in the scale that you're willing to own. In terms of sector specific, it's still not a lot of green in the short to intermediate term, though it continues to improve. You see consumer staples and utilities, though, are the ones that stand out as the healthiest at this point. Both of those sectors are defensive, so that also in itself, while it says something about the strength of these two sectors, says something about the defensiveness of the current market. Healthcare, the biotechs continue to be taking a beating, and it may be the year, being a political year, it's just going to take a hit on the healthcare sector. Remember, this is being primarily driven in this weakness by biotech, and biotech has just been a target for especially the Hillary campaign, but really there's not a lot of friends to the pharmaceutical industry, and they're certainly taking something of a hit. So while from a fundamental standpoint you could argue there's not a lot of change that has changed this industry as of yet, just the threat of the negative publicity and the impact potentially on pricing structures has a threat on potential change in profits down the road, which is without getting too political here, probably a bit distressing because biotech is where the future of this industry is from the pharmaceutical standpoint, with the other aspects of the pharmaceutical industry probably greatly diminished from where they were 10 or 15 years ago. In terms of percent change, here you see a little bit of a mixed bag. Energy took it hard yesterday, as did financials. And it's also of note to note, look at the financials here. The year to date, the 3-month return, the 1-month return, and even yesterday, financials in the negative. If you expect to see a healthy bullish market, financials have to be doing well. It just will not happen without the participation of the financials. And indeed, despite the Fed's efforts to raise interest rates, which should be positive for the financials, that is not what's actually happening in the marketplace. And in fact, you see things like the REITs and the utilities. And look at who was the top performer yesterday, utilities. Those are the places that are doing well. So that is not good news to the financials, which ultimately is probably not good news for the broad market. Okay, we've gone long enough for today. I'm going to go ahead and wrap up. We're going to flip past the rest of these slides. You can hit the pause button if you want to go to the hyperlinks or explore some of this in more detail. We'll talk more about this on other days. Disclaimers as always, hit the pause button if you need more time to review, and you see the hyperlink for the full disclaimers. We'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.